guys got the dynamic asset class stuff. If you wanted to take pictures, dynamic asset class, you could do that. No, you already got it. Good. Financial product innovation notes, if you want to take some pictures of that. That. Here's some introduction to derivatives. You want to take pictures of that.
Like calculus derivatives?
No.
No. Never mind.
It's not that kind of derivatives. Then you got that, right? And the solutions. I think that's all that I got. So I'm ready to answer any questions you guys have.
What do you like to do for your hobbies?
I used to surf a lot, and then I really like to ski when I can.
Oh, you like surfing?
I surfed a lot, and then skied.
Okay.
And I like to watch rugby. I used to play rugby. I like it. And my body gave out. So.
You just make billions of dollars.
I do okay. You don't make a lot of money as a
Like, I
therapist.
don't know what to do. I'm so confused.
That's why I have other businesses.
Okay, okay, okay. Oh, go ahead. Okay.
All right. So, any where would you guys like to start?
I have a lot of things already written down.
I think I'd like to start most basic with all the trading things with gold and oil.
Okay. Do you want to do the dynamic supply demand analysis, or do you want to do?
I
just
want to, my basic
just the
question
table?
is to know the reasons why they're shifting. Like if the Dow is up or
Okay.
down, why is
Okay.
it up or down? That's
Okay.
kind of how I need
Okay.
to find
So that's really that dovetails into two
out.
questions,
Yeah, it
right?
does.
You know, it's the current. Are you following the markets, and then what drives the prices up and down?
Right.
Okay. And then I always use the supply demand analysis.
Okay.
Okay, that goes into my brain.
You want to
So I'll do both.
Oh, you already got it?
No, he just did this in class one
So
time.
again,
Well, I think I have this.
I set up, you know, the supply demand charts. You got supply, and I'll do the demand too. Let's start with the stocks, because stocks are actually stocks are driven not only by supply demand factors, but also by financial factors. And I'll get into that too. So the first thing I'm going to do is I'm going to set up the supply curve, the demand curve. You know, supply, demand. Then if I do everything right, it aligns with each other. This is going to be your quantity demanded. This is going to be your quantity supplied. Right? And this is your equilibrium point. And this is going to be your price. Price. And then star. And we'll do stocks first. I'll answer the stocks using the three different approaches. So the first thing is, what would cause the supply curve to shift back and the prices of stocks to go up? Okay. There we go. So we know if the quantity supplied shifts back, right, and then the prices are gonna go up. And what would cause the supply curve to shift back? That's gonna be stock buybacks. Now, reverse stock splits will also do that, but those are so rare that they don't have an impact on the market. So really the first is the stock buybacks. Okay. And then what would cause the supply curve to shift out and the prices to go down? prices are gonna drop. What would do that? Those would be, initial public offerings. And seasoned and secondary offerings. So these IPOs are, like Facebook and, who's going public now? Like, LinkedIn's already gone public,
I heard
Facebook,
Uber's gonna go.
Uber's gonna go, Lyft's
wow.
gonna go, there's a bunch of other companies that are gonna go
Mhm.
public. So those are new supply of shares coming into the market. And then there's existing companies that are already trading, on the stock exchange, and they need to raise more capital. So they're gonna issue more stock, okay? And those are seasoned or secondary offerings,
Mhm.
okay?
And that would make it shift out because
Yeah,
there's more
so as people
supply.
start to issue more
Okay.
shares, then that's gonna
Okay.
shift out the supply curve.
And it decreases the price.
And it's gonna cause the stock prices to go down, okay, if there's a lot of them, okay? And then what would cause the demand curve to shift up for stocks, right, causing the quantity, right, that's the standard deviation. Causing the quantity demanded to shift out, causing the price to go up. So what would cause demand for stock to go up? Okay, one would be falling interest rates. That would be one. Higher expected returns. Economic growth. Higher expected returns, also earnings. Earnings expectations, falling interest rates, cost of capital, and expected returns. Hold on. Cost of capital and let's just keep that. Okay, so those are some reasons that would cause demand for stocks to go up. Okay, and then what would cause the demand curve for stocks to shift down, quantity demanded, shift down, and obviously
The opposite of those.
the prices, yeah, and I would just do the opposite. So I do rising interest rates, cost of capital, lower expected returns, earnings, and let's just say higher here. Here I'll say economic growth, lower. So those are, the supply demand factors. That would cause stock prices to go up and down. Okay. The other, it would be financial. Okay. And what I'll do is I'll use the Gordon growth model for the illustration. I'll use intrinsic valuation theory. So I can look at it this way too. And I could use the perpetuity, Gordon growth I'm doing is I'm overlapping with some other areas on the exam. So the perpetuity model, we know is CFO T plus 1 divided by the expected return. It's going to give you the value using the perpetuity approach. And this I could also be a capital asset pricing model equals risk-free rate plus the beta times the return on the market minus the risk-free rate. This is your expected return on the equity. So that's one way of looking at it. So if you know that interest rates are going to go up, right, then the expected returns are going to go up and the values are going to go down. Okay. If we know that the risk-free rates are going to go down, then the expected returns are going to go down and values are going to go up. Okay. That's just very simple. For the Gordon growth model, it's CFO T plus 1 I minus G equals the Gordon growth. We've already played with this one, so we know we've already played with this, so we know what the impact is going to be. So the next one is really growth expectations of the cash flows. Okay. The G is the expectation that these cash flows are going to grow at a constant rate. Okay. So if G goes up, values go up, and if G goes down, values go down. So here, under the Gordon growth, if you think earnings expectations are going to go up in the future, and you think earnings are going to grow in the future, then when the earnings expectation growth rates go up, then the value of the stocks go up. And when earnings expectations go down, growth rate expectations go down, then the value of the stock goes down. So the traders and the investment participants are thinking about it in this context, using microeconomic theory. They're also thinking about it using finance theory. Okay. And then the multiple approach is the CFO T plus 1 times the multiple T plus 1 equals the value using the multiple approach. And the multiple can be a bunch of different things. Could be 1 divided by I, could be 1 divided by I minus G, could be earnings divided by, let me take that back, the price of the stock divided by earnings per share. T plus 1, T plus 1. So those are ways to calculate multiples. Or I could look at the price to earnings multiple, the PE multiple, PE multiple. I could forecast what I think the stock price is going to be next year, along with the earnings per share, and get a forward multiple. And I could also use other company PE. So I can go find other companies like our company, same sector, same size. And look at their price earnings multiples and apply them to our cash flow to get the value. So that's the multiple approach. And I'll get into more of this later on in the semester, but this is, you guys are getting, you're getting more for your money here, obviously. And then the DCF, right, is going to be the present value. DCF is going to be equal to the sum the cash flows, T plus N, divided by 1 plus I to the N, plus the terminal value, divided by 1 plus I to the n. So that's a little bit different than the equation that I put in class. Okay. And remember I did the 2-year
Yeah.
example, so this is the equation. So this is just the discount of the dividends, cash flows, and then you have the terminal value. Okay. Just theoretically, what drives stock prices up? Well, obviously, increasing cash flows in the future. You think the cash flows are going to grow faster in the future, and that's going to cause the present value of the stock to go up. If we think that the required rates of return are going to go down, that's going to cause the present values to go up. And if we think that the terminal values on the back end are going to go up, then the present values are going to go up. Okay, if we think that the cash flows in the future are going to stagnate or go down, then that's going to cause the present values to go down. If the interest rates, or the required rates of return go up, values are going to go down, and if the terminal values go down, then the present values are going to go down. Okay, so that's the finance theory that drives, where you think stock prices are going to go in the future. Okay? Did that answer your question?
Yeah.
And then the last piece is for the current table that
Yeah,
so
right,
you
right.
got you got the level,
Right.
right, and you got stocks, right, and that's going to be the Dow. And what's the Dow at, like 15,000 right now,
Yeah.
something like that. So that's the level.
Uh-huh.
And then is it up or down? It's mainly been down, right?
Yeah.
Recently, and got hammered, at the end of last year. And then what was the next one? That was Y, right? Y, and you got like trade wars, right? Has been a major impact, on it. You got higher interest rates. Right, and then the last is what? Lower earnings expectations due to Europe and Asia recessions. Those are going to drive stock prices down. Okay. And then the other ones, right,
Yeah.
for that other
Yeah.
question.
Okay.
So
Okay.
that's kind of the full, but that answers like a little piece of 3
Yeah.
questions.
Yeah, exactly. Okay.
Okay.
Cool.
All right. And you guys can take pictures of this because I'm running out of space.
Yeah.
So you may
Yeah,
want to take
that makes
pictures
sense.
of this stuff
Okay.
as I move through it.
Yeah.
Okay?
Cool.
Yep, and I got it. And I'll probably post these things like tomorrow, because I got a couple more. So you guys can review over the weekend, all right? You want to take a picture of this?
Go downstairs for 5 minutes.
And you missed the whole lecture.
And all this happened.
How long did that take?
Yeah.
10 minutes?
Yeah, that's
Yeah.
awesome.
Oh,
Yeah.
So again, these are the factors that drive, that shift the supply curves, shift the demand curves, and then this answers the question on the 4 intrinsic valuations.
Yeah.
Okay, perpetuity, Gordon growth, multiple approach, and then discounted cash flow, and then this asks a piece of the current, where the current markets are. Okay, so there's a little bit of everything here. Okay. Did you guys get yes?
yeah, we were confused. Can you go over the multiples approach just one
Yeah.
more time?
Yeah.
Okay.
So this is the same cash flow,
Yeah.
next year's cash flow,
Yeah.
times the multiple.
Okay.
So it could be like 13 times,
Okay.
22 times, whatever it is. I can get a multiple by using the perpetuity model.
Okay.
Let's say the multiple is let's say my expected return is 10%.
Mhm.
0.1.
Yeah.
So what does that make? What's my multiple?
10.
10. So I can use my expected return to calculate the multiple.
Okay.
Okay. The other is, let's say it's 1 divided by 12. 0.12 minus 0.02
Yeah.
using the Gordon growth.
Same.
0.1, my multiple is 10 times. So basically, using expected returns or cost of capital or my CAPM, I can manufacture multiples.
Wait, so, okay, maybe I'm just reading it
Or
wrong.
you do talk about this one.
So above the main equation, the CFO
Here?
over, yeah. What is that?
That's the Gordon growth.
Oh, that's still Gordon
I
growth.
believe this is the Gordon growth right here.
Okay, that's why. Cool.
That's Gordon growth. See, it was, I guess it was confusing because it looked like it was bleeding into it. And then this is the multiple approach right here.
Cool.
Okay.
Yeah, I just
Got it.
mixed everything
Sorry,
together.
I go pretty fast.
No, it is no problem. Very good.
Okay, any other questions on clarifications? No? Okay, got it. Okay, next.
Yeah, so for like the levels and stuff, so like let's say for the next one is oil, let's say, so we gotta determine what the price is, up or down, and then why is it similar stuff, like
Yeah, so
kinda as you were explaining?
it's an asset class, oil, level, what is it trading at, like $55 a barrel?
Yeah, I think so, it's around there.
So $55 a barrel, got it. Is the trend, you know, is it up or down? Actually, the trend has been up, right?
Yeah, it
The question is, why OPEC cutbacks? And I think these were also factors that I went over in the dynamic supply demand
Yeah,
analysis.
okay.
So OPEC cutbacks, you got Venezuela and Iran, right, embargo, right, because we basically put an embargo around them and said, you can't buy Iranian or Venezuelan oil because we've got sanctions on them.
Okay.
I just call it an embargo. And then you might have, you still have a growing US economy, right?
Mm-hmm.
You know, in China,
Okay.
China's still growing at, 6% plus, which is pretty good, right? So they're sucking in a bunch of oil. So those could be the factors that would bring it up.
Okay, cool.
War would definitely be a factor
Yeah,
for
but
it to go up or
But
down.
we don't have, right now, the Straits of Hormuz, is not being blockaded by the Iranians or the Russians or anything like that, but it could have a major impact, but that's not the current situation. Okay. But that could be one of the factors over here when you do oil, it would be your negative supply shock. So that would be one of the factors for oil, would be a war or a blockade of the supply line, through the Middle East. Okay.
Cool.
All right. Any other questions? Everybody's clear on the financial innovation piece. It's just kind of memorization, except for the S curves and the product. Everybody makes a mistake on the S curves. Okay.
Okay.
They all make the mistake on the S curves. So this is time. This is technology.
Yeah, this was portfolio.
Yeah, I'll do portfolio theory next, because everybody makes the mistake.
Yeah, that was a big one.
So here are the S curves, they go like this. I get stuff like this sometimes, and then I get a lot of these. Like that, okay?
Yeah.
It's a little bit more nuanced than that,
Okay.
because the S curves have to be contingent with each other, right? Because I want to be starting new technologies, while the other technology is starting to deteriorate. Or decline. So you want your S curves to be contiguous with each other, okay? And this is S1, S2, S3, S4, S5, S6, S7, S8. And what I like to do is I like to see, you know, the dots, so you understand that each technology is different but is contiguous. And this is obviously T1, T2, T3, T4, T5, T6. This would be time. And this is technology, so probably do small T1, T2, T3, T4, T5, T6, something like that. So that's the way it should look. And then the key to this whole thing is that, like I'm IBM, IBM's probably not a good example, but it's a pretty good example. IBM's been around for what, like 80 years or something like that. They came up with the first computer. They worked on, you know, intercontinental ballistic missiles. They did chips. They did, you know, DRAM chips, flash chips. So they've been inventing technologies just like Xerox and stuff. These companies just have been, you know, technology incubators and machines for basically years and years and years and years. And if companies can basically can invent new technologies or new products, you know, from the technologies consistently over time, the market is going to say, well, if you guys have done it in the past, you can do it in the future. You're going to be able to do it in the future. So what it does is the market starts to assume that they continue to innovate in the future. And what this becomes is a technology growth path, okay? And this becomes a revenue growth path, okay? And if the market assumes that you can continue to innovate new technologies consecutively over time into the future, you'll be able to grow your revenues into the future forever, okay? And if you can grow your revenues or your earnings forever into the future, it basically boils down to the Gordon growth model, which is CFO T equals infinity, right? Because they can do it forever. And if you use the Gordon growth model, the goal is to maximize the value of the firm. So if you can maximize the growth rate in the cash flows consecutively over time forever, you're going to maximize the value of the company. Okay. And it's the same thing for the product adoption cycle. If you can continue to innovate new products consistently over time and you're successful, which Microsoft has, you know, Salesforce has done a great job, Nike's done a great job, you know, all these companies have done a great job introducing new products consecutively over time. Apple's done a great job over time. Then again, as you innovate, you go through the product adoption cycle, right? As you continue to layer on new products, it creates the same growth curve expectations by the marketplace. They assume that you're going to be able to max out the growth rate and the cash flows forever, and you're going to max out the value of the firm. And again, if you make a mistake, right, then this is going to turn negative, and then it's going to turn negative, and the share prices are going to collapse. That's what happened to Yahoo. Right? They screwed up, and who knows what's going to happen to Facebook, right? Because basically their business model's being compromised because they leaked. They sold too much personal information, and now they're looking at regulation. Now they're going to create private spaces, you know, on their network, which means that their ad-based revenue models are going to be disruptive. Everybody adopts the private environment over the public environment. So Facebook could be looking at a significant correction in its stock price.
Let me just go down, then they can pull it back and go up. If they can recover from that, then this would be.
Yeah, and it's all communications, right?
Okay.
You know, it's going to be Zuckerberg and Sandberg, and those guys are going to need to basically manage the market, manage the expectations, and communicate with the marketplace. And if they can't meet the communications expectations that they set, you know, with the investors and the consumers, and now the government, because they want to regulate them. If they mess up on the communications and they don't execute, or their business model becomes flawed, then the ability to grow this revenue path is gonna be impaired. And then people are gonna lower this, and the stock price is gonna fall significantly, which it has. So it's really volatile right now. Okay. Any other questions? Let's do, you wanna do the modern portfolio thing? Because that's usually where everybody makes a mistake there.
That's the one that we just went over, yesterday?
Yeah.
Yeah. I got that one pretty good, I think I
Did you?
understood that for the most part.
Yeah, the key to that whole thing is, I think what a lot of students do is they're impatient,
Mhm.
you know, when they're drawing it out, they just wanna get it done with.
Yeah,
So they don't take the time to actually, lay it out
Right.
strategically, right? The way
Mhm.
that I laid it out.
mhm,
They try to skip steps, and the detail in it, gets screwed up. Cause I see a lot of time, I see a lot of this, they can get this piece, but I see this, and I see a lot of that,
mhm,
okay? So that's not what I'm looking for. The
right,
exercise is also a test in attention to detail,
mhm,
okay, which is part of the exercise, okay, is to see if you can really focus on the detail, because you're gonna have to. When
Right.
you get out in the real world, you can't, you know,
right,
you gotta have capitalizations and periods, and, you know, everything's gotta be perfect. You know, if there's one little thing that's off, everybody's gonna read it and go, you know, come on, they forgot a period, they forgot to capitalize it, I mean, their numbers were transposed. You know, I reran the numbers and they were off, you know, instead of 6%, I came up with 4%, it's
mhm,
kind of a big deal,
mhm,
right? All right, so this is gonna be your risk-free rate. And then what I do is I start here, with the market basket, and then this is the hardest part. And you gotta make sure that your umbrella is like that, and that it comes down like this, and this is above the risk-free rate.
oh, okay,
This took me like so long to be able to do. I used to screw this up so bad all the time. So that's when I start first, because that's the hardest, right? And then what I'll do is I'll put in the umbrella, and then I'll go 100% stock, and then I'll go 100% bonds, and this is my capital allocation line, and this is my efficient frontier. Okay, so I'll start putting in these little dots, like this, and I'll put some dots here, right? And then we'll put some dots in here. So these are all the portfolios that I can construct by using, you know, the assets that are in the capital markets. And then what I like, these here, right, I can, I'm willing to take, oh, and I do like this too. So I got the portfolio standard deviation, this is the standard deviation for the stock portfolio. This is my expected return, and my expected return on my stock portfolio. This is the standard deviation for my bonds. This is my expected return on my bonds. And then this part where the market basket is, this is my optimal portfolio standard deviation and my optimal expected return. So these, if I'm willing to take on more risk to get a higher rate of return, I sell off my bonds and I start buying more stock. So I can move up the efficient frontier to 100% stock portfolio. I'm gonna get a significantly higher return, but I'm taking on significantly higher risk. And I can also move down the efficient frontier by selling off my stock and buying more bonds if I'm trying to reduce my risk and I'm willing to take a lower rate of return. Okay. All right. then the other one that I do, which is tough, is I go right here, and I go like that, and then I go like that, and then I go like that. So these are my utility curves. And everybody wants to be up here, right? High return, low risk, well, there's nothing out there, okay? So what they're gonna have to do is they're gonna have to lower their utility. What they do is they lower their utility to the point where the utility curve, capital allocation line, and the efficient frontier is tangent. They're all tangent to each other, and that's called the market basket. Okay? And remember, the market basket historically, in the 50s and through the like the 30s to the 50s was 70% bonds and 30% stock. So that's how the market basket looked like, historically. And I'll get into those later. That just kind of gives you an idea. The other thing that's important to understand is you can jump off the efficient frontier onto the capital allocation line. And you can move up the capital allocation line to the point where you're going to get significantly higher return through the use of leverage. And you're going to use margin on your stock portfolio, and you're going to use mortgage financing on your real estate to lever up. And as you leverage up your assets, your stock portfolios and your real estate portfolios, the volatility in the cash flows increase significantly. Okay. So this is leverage. Got it. And I can also move down I can also jump off the efficient frontier down here and move down the capital allocation line to here through the process of lending. So I'm going to reduce my portfolio standard deviation of the risk significantly, but I'm also going to reduce my expected return significantly also. So this is where I'm super risk averse. I'm focused on reducing the risk significantly more than the return. I really don't care about return, I'm just more about reducing the risk in the portfolio. And when I do the lending, if I am a brokerage firm, right? I'm a brokerage firm. I'm the brokerage firm. I'm lending to the investor, who wants to buy more stock. If the stock prices go down, I'm going to give them a margin call. And if they don't put up the margin, I'm going to liquidate their securities to pay off the loan that they owe me. Okay? So the loan is collateralized by the securities. And if I'm a bank, I'm going to lend you the money to buy the property. If you default on the mortgage payment, I'm going to foreclose on your property, I'm going to take your property, and I'm going to sell the property to extinguish the loan. So it's safer, it's a safer approach because the assets collateralize the loan.
So that's what banks do.
That's what banks do. And that's what the brokerage houses do.
Okay.
They have a lending arm. Because
Yeah.
if I borrow from the brokerage firm because I want to buy $200,000 with Apple because I only got $100,000,
Yeah.
they're going to charge me 9%.
Uh-huh.
Okay, but if the stocks go down and I give them a margin call, you got to put up more equity. It's like I don't have the equity. I'm going to sell the stock and pay back my loan, pay off the loan.
Just a random question, when they do that with houses, the banks,
Yeah.
do they sell the houses for a profit as well? Or they just sell it just to
They
pay
just
off
sell
the
it
loan?
to pay off the loan. They don't
Okay.
care about profit.
Okay.
Because they usually make their money off of, not off flipping homes, off fees, the closing costs, because they're going to charge you points and stuff like that. So the more loans they originate, they're not only getting fees, you know, on the loan volumes, but they're also getting mortgage interest income. Okay, and if the values go down and you default, they're going to take your property, you're going to sell it as fast as possible. And if they do incur a loss, they can charge it off. They can do a charge off. Okay. All right. And then what kind of ties in with this is the portfolio allocations, the market baskets, the target model portfolios. So 30s to, it was actually like the 30s to almost the 70s actually. That stocks and bonds were the dominant, you know, portfolios. You know, that constructing the portfolios were mainly stocks and bonds. And then it was really in the 80s that you saw the reduction in bonds. Stocks basically stayed the same. And you saw the introduction of real estate start to be put into the portfolios. And then in the 90s, you saw another reduction in the bonds to 50%, and then 30% for stocks, bonds, 10% real estate, and then 10% in insurance. So that became the new allocation, the new market basket, the new target portfolio, the new model portfolio. And then in the 2000s, you know, this was all Ibbotson and Associates, you know, that did this research. You couldn't, back here we didn't have the technology. It wasn't until like the 80s that Henry Markowitz created the optimization model, modern portfolio theory. And with the advancement in supercomputers, mini mainframe computers and desktop computers, we could actually run the Markowitz optimization procedures on the computers because they were so data processing intensive. We couldn't run the algorithms. They were just too big. But the advancement in technology allowed us to then be able to run the mathematics, and it birthed the mutual fund industry, and then birthed the exchange traded fund. And then technologies in conjunction with the mathematics now pushed finance into the financial engineering and into product development phases. So technology changed everything. And then in the 2000s, we reduced the stocks to 40%, the bonds to 40. Stocks, we always kept the 30%. We gave a 10% to real estate, 10% to the insurance, and then the new asset class that emerged in the 2000 period was alternative renewable energy. And this asset class has only been around for like 15 years. So it's really new. These are called alternative. Assets. And the beauty of these have become extremely popular. And the beauty of these alternative assets is that they have low, no, and negative correlation with stocks and bonds. So they're great diversifiers for pure stock bond portfolio. Stock bond portfolios are extremely sensitive to movements in inflation expectations, and interest rates. These are very insensitive to movements in inflation expectations, and interest rates. So their returns have low, no, or negative correlation with stocks and bond returns. So if you stick the alternative assets in the stock bond portfolio, it bows out the efficient frontier, okay. Which is a unique. It was only really real estate, and then I came across insurance and realized that it actually did the same thing. And then when I looked at alternative renewable energy, it did the exact same thing. So it bowed out the efficient frontier. Now, obviously, your expected return is gonna go down, but you're gonna get significant reduction, you know, in the portfolio standard deviation. So the equation, which is your expected return on the portfolio divided by the standard deviation on the portfolio equals your risk adjusted return. Well, I'm getting a reduction in my expected return by investing in these alternatives, but I'm reducing my portfolio standard deviation significantly more, which means that my risk adjusted rate of return on the portfolio goes up. And if I can lock in 8% to 10% expected return on the portfolio, then the assets within the portfolio are gonna double in less than 10 years. If I can do that, I meet the minimum requirements for all institutional risk-averse investors. And if I invest in these, I get diversification. So if I can lock in the return and reduce the risk, I can increase the risk-adjusted rate of return, boom, the money's gonna start flowing in, okay? And I'm gonna grow the assets under management, and I'm gonna be able to charge a fee, and we're gonna make millions of dollars, okay, as an asset manager. Okay, so that's huge, okay? Then the last piece that I figured out years ago, which I thought was pretty amazing, was that the insurance piece, the life insurance piece here was huge. Particularly for potentially senior level executives and principals, and the life insurance was huge. So you go work for a company, you become an executive, they're gonna slap millions of dollars of life insurance on you. Okay, you're gonna go run nonprofits, startup companies, you know, a family office, you're gonna be managing the family office, you're gonna be working your way up in corporations, you're gonna need like a ton of life insurance. Because if you go down, everybody's gonna get taken out, okay, you're too valuable, okay? So the only way to hedge off the mortality risk is to slap the life insurance on you. If something was to happen to you, the life insurance would pay out to the startup companies, to hire new people to take over for you, to replace people in your nonprofits. You were the chairman of the board, you were the major contributor to the nonprofit, we gotta hire somebody else, and you gotta pay them an endowment and maybe set up an annuity. You gotta basically inject liquidity into the corporation to find somebody to replace you, and you need to find somebody or a bunch of people to replace you because you were managing the real estate and the stock and the bond portfolios within the family office, not only on behalf of your family, but all the other families that were co-investing with you. So there was huge damage if something was to happen to you. So by getting the $25 million life insurance policy on you, that money is injected into all of those operations, injected into the estate and the portfolio, and the expected return on the portfolio jacks and actually moves the estate and the stakeholders onto a higher utility curve and allows you to get instantaneously significant return on the portfolio. This is exactly where the investors wanted to be originally, but they couldn't get on the utility curve. But by the use of the insurance, the stakeholders, the stockholders, the family was able to get onto a higher utility curve by the death benefit basically paying out into the portfolio. And if it's done correctly too, the death benefit will extinguish all of the taxes on the capital gains, and will pay off all the margin and the mortgage on the assets, so that all the assets go to the heirs on a stepped up basis, tax-free and debt-free. Okay. That's how they do it.
Just a quick question, so on here, it says modern and post-modern.
Yeah,
portfolio theory.
so that's the modern,
This is the modern?
that's the modern piece, because you're getting the bowing out of the efficient frontier through diversification into alternative
Okay.
assets. The postmodern
Is the life insurance
No, that's actually part of the modern portfolio piece,
Okay.
okay? It could be post, but I'm just gonna keep it in the modern. And then the post-modern is the bowing out of the efficient frontier. I can bow out the efficient frontier by using derivatives as a tool to apply portfolio insurance. Through the process of financial engineering. Okay, so I was able to bow out the efficient frontier through the alternative assets. I can also bow out the efficient frontier through a prudent application of the derivative contracts. So if I think that the value or the prices of the assets, along with the returns, are going to go down. Right? So how do I hedge off the market risk? Okay. First thing I'm going to do is I'm going to look at indices. I'm going to go find some indexes whose the indexes are correlated to the asset prices in the portfolio. They move together, okay? And I'm also probably going to be investing in ETFs in my portfolio, and I'm also going to be investing in stocks, okay? So if I think that the prices and the returns on the portfolio are going to go down in the future, I can hedge off that risk by writing the forwards, by writing the futures, by writing the calls on the futures, and by buying the puts on the futures. Now, when I buy the puts, it's going to cost me money, so it's going to reduce my expected return, but it's going to reduce the risk within the portfolio significantly more than the cost, so it bows out the efficient frontier.
How come you buy the puts and not write the puts for that one?
Because the put contracts, because I didn't get a
Yeah.
chance to go over this,
Yeah.
but this is basically, so basically if I think I'm going to buy, these are puts,
Yeah.
right? This is my premium, and I'm going to have to buy the puts, so as the price goes down, I'm making money.
Right.
Okay. And then these are the calls, right? So as the
Yeah.
value goes up, I'm
Yeah.
making money. I'm still, in both cases,
You're buying.
you know, I'm buying, and then actually here I could be also writing the calls,
And then
and I
down
could
there.
also be writing the puts.
Yeah.
Right? So the money here is negative,
Yeah.
it's going out, but when I write them, actually money's coming in.
Because if you write that put down there and the price goes up, then you're making money, basically.
Yeah.
Yeah.
Yeah. You make money,
Because
when you buy the puts, you make money when they go down, when you
Yeah.
write the puts, you make money when they go
Go
up.
up, yeah.
Okay? You just take the offsetting position.
Yeah. Right. Okay.
And then since I have ETFs and stocks, you know, in my portfolio, I gotta hedge off the downside risk. I can do that by selling short, by writing the calls, and by buying the puts. So that way I hedge off. And by applying these derivative contracts as portfolio insurance, on financially engineering the solution that bows out the efficient frontier. It reduces my expected return because these are costly to implement, but it significantly reduces the portfolio standard deviation and increases my risk-adjusted rate of return. And if I can lock in an 8 to 10% rate of return, even after applying these, the money's still gonna, my portfolio is still gonna double
Right.
in less than 10 years.
Hmm.
So we win.
Mhm.
Okay, so it's the solution to
Okay.
win. And winning's all that matters,
Yeah.
right, in this game,
Yeah.
right? Because if you lose, you're screwed.
Every game, winning matters.
Okay?
Okay.
Right. What other?
Alright, I gotta head out of here.
Okay.
Thanks, thanks so
Yeah,
much,
you're
that
welcome.
helps. Is there anything in specific I should focus on more than
Well,
other
it's gonna be,
things?
the technical analysis too.
Yeah,
Most students don't.
I'm really good with all of the math problems, like math and
Yeah,
numbers
yeah,
is good
yeah,
for me.
this is
that-
like your qualitative artistic side.
Yeah,
And
yeah.
then you got quant and art, right? So
Yeah,
you-
exactly, so it's
So I'm developing both sides of your brain here.
yeah, so for me, it's a lot of like the definitions or like concepts of understanding why we do things, all of that stuff is the
Yeah.
difficult stuff. Like
It
the problems,
is.
I can solve
No,
all the
totally.
problems,
Yeah,
but
everybody, none of the students have a problem with the math.
yeah,
It's all the qualitative stuff.
yeah,
That's
exactly,
the challenge.
yeah,
So
okay.
I give you both.
Yeah, so do we have the solutions for a lot of those, like, the question problems?
That's what
on-
that's what this is.
That's what this
Yeah,
is
so you
all-
gotta go back and
Okay.
review, and if you still kind of mess up on it, what I'll do is I'll check it, and give you some comments. And
Mhm.
then what you do is you go back and you review the video,
Okay,
and then you just clean it up,
yeah,
and then I'll take another look at it,
okay,
and then you'll go back with like a red pen,
okay,
and correct everything so I can see that you corrected it.
right,
Either blue or red or whatever you wanna use, and then if you still afterwards, there's still just little minute stuff, I'll go over it with you so you can see
Okay.
exactly, where the detail piece
Okay.
might be missing. But it's usually the S curves,
all that stuff,
it's usually this one's the hardest
yeah,
for everybody.
yeah,
And then what they do is they don't do, it like that, so you can't see the support, resistance, breakout, right? The support,
Mhm.
resistance, the head, the head, the shoulders, the breakout to the downside, right? Let's
Mhm.
do that one, breakout to the downside, you got the upward trend and downward trend, that's kinda what I was looking for. Just simple technical analysis, so if you look at a stock chart, you
yeah,
can do the technical analysis
right,
and see what the pattern of the pricing has been over time.
okay, okay, cool, and we got Tuesday and Thursday, and we're working on it both days,
Yep, and I'm
Sweet.
around, so.
sweet,
And I'll
okay,
do this again on Wednesday afternoon,
okay,
Format question, is it gonna be the same format
it's
as
exactly
this?
the same.
Is that, it is?
Exactly the same.
Okay,
So we have to do this on separate piece of paper, because that's,
Huh?
we're gonna do this on a.
I'm gonna give you I'm gonna give you a blue book, and I'm gonna give
Okay.
you a clean, exam, and then you're just gonna go at it.
okay,
Okay, no
cool.
tricks,
Sweet.
nothing.
sweet,
So, the first day, it's gonna be the writing, the second
You can do
day is
whatever
the-
you want,
Oh,
you
sweet,
can do whatever you want.
cool,
Okay,
alright,
cool.
thank you.
Yep. So
Alright,
if you
have
wanna
a good
blow
one.
through and answer the ones you know first, just leave some
Mhm.
space, right, and I'll have some
Okay.
extra blue books there if you need them. But
Mhm.
just make sure it's, you have, if you do stuff, but you wanna go back and do this, just
Yeah.
give yourself a couple pages or something.
yeah.
Yeah.
So everything flows, so that when me and my
Going through it.
TAs are
Yeah.
going through it, we can just check everything and everything. We become a manufacturing machine, and we just sit down for like 4 hours and burn through all
Yeah.
of this stuff.
Okay.
Okay, any other questions on any of those? You're all clear on the regression model and how to write that out?
So this one would be the technical analysis? which
Yeah,
is-
and this is the support, this is resistance, that's the breakout right there. This is the accumulation, the consolidation, the
Yeah.
sideways pattern, the trading range, right there. And as you can see, this kind of sets up another support, there's the resistance, there's your shoulders, there's your head. You can see that the stock price has been in an upward pattern, it's been in a downward pattern. Looks like it's forming a support there, but it breaks out to the downside, breaks out to the downside there.
So your resistance is gonna be your top line.
Yeah, the
Hold on.
resistance is the top, and then
Okay.
the key here is, as you can see, right, like right here. See, it was trying to form a bottom right here,
Mhm.
right? So there's like a little support, and a little resistance right there, but it breaks out to the downside. Looks like it was trying to form a support and a resistance there, but it broke out to the downside. And then what you'll find out is like stocks will trade like this. What they'll do is they'll go up and down, and then you see how right here, there was a support right here. Boom, boom, boom. So it was like forming a support over here, but then information came out and it like caused it to break through the long-term support. And that's what you see in these stocks, is they'll go up, they'll form a support, in a resistance, they'll trade in a range, then they'll either break out or break down. And then what you'll see is there'll be like a historical support that will form here, and then the negative information will come.
So how do you predict if it's gonna go down or up?
Well, it was already in a downward trend.
Okay.
It's already going on a downward trend. And then if it starts to form a weak, trading range here, and the volume in the stock starts to dissipate, there's not enough demand.
Oh, those little graphs underneath?
Yeah, the little volume charts down here, the RSI, the MACD, you start using all of those to do the analysis and then say, there's some weak technicals here, and I don't think the price is gonna hold up.
And so you're gonna want us on the exam for that one, you're gonna want us to.
You wanna draw it out like this,
draw it out,
list the technical trading strategies
okay,
that we went through,
yeah,
and then you gotta say support, resistance,
yeah,
breakout, support, resistance, shoulder, head, peak,
okay,
upward trend, downward trend,
yeah. Cause I think I'm fine with the graph, but just, cause in here it has a bunch of different questions, like, in comparison to the S&P 500.
Oh, let's see. Which one's that?
Isn't it top one?
This one?
Yeah.
No, that's a different question.
Wait, which question is this one?
That's the technical analysis, that's the very
Oh,
last
it's
one.
this
No, the yield curve versus the S&P 500 is very simple. It's when the yield curve inverts.
one. Yeah.
The stock market, S&P 500 peaks in less than 12 months,
Mhm.
and we're in a recession in less than 24.
Oh,
Okay.
that's that graph you showed on the projector, where
Yeah.
it's just like,
Yeah.
Yeah, it was going, and then when it went,
Yeah.
it peaked, and then,
Okay.
what was that website called actually?
that's, you type in dynamic yield curve, and then you go to stockcharts.com. So you can just Google it. It's pretty an interesting exercise, actually. Any questions? How are we doing on time?
It is 120.
It's 1:30 for that.
Oh, okay, cool, we're ahead. You're all clear on the regression equation, external validity, internal validity, how you do deal with multilinearity, how you decide which variable to keep, which one to throw out.
Can you go over how to deal with multiple?
Yep. Did you guys take a picture of this? Alright.
Where in the packet is?
It's the very first question.
Oh.
And it was also on your pre-test.
Mhm.
So I'm just gonna do an abbreviated regression equation. I'm not gonna put all 5 variables, but if you can put in all 5, that would be awesome. So we're trying to forecast the dependent variable,
Mhm.
right? This is the intercept, the beta coefficient, That's your estimator. There's your first variable, plus, and then how many variables, what's the limit? What's the maximum number of variables we want? No more than 5. I mean, 1 is too little, 3 is probably about right, 4 is good, 5, you may run into a problem, but no more than 5.
Okay.
Okay?
Then you run into,
You wrote multi-collinearity in most cases. Okay, and then the error term's also an estimate. So I'm kind of looking for that structure. I like to see all 5, all laid out. Okay, so the question is, if I have 2 variables in my model, right? This one and this one, and they're highly correlated. I'm gonna run a correlation, correlation on it, correlation coefficient. And they're highly correlated, they're also highly correlated to the dependent variable. So I don't need both of them, I only need one of them. Because they're both highly correlated, but they're correlated with each other, so I'm getting multicollinearity in my model. So I gotta get rid of it, because I don't need both of them. So the question is, how do you decide which one to keep? So this one over here has a high t statistic, and it also has a high correlation coefficient. So under statistical theory, you would pick that one.
Because it has a higher t-stat?
Yeah, higher t-stack, and it's highly correlated. So let's say this one has a higher t-stack than this one, and this one has a higher correlation than this one with the dependent variable. So I picked this one.
So if that one just had a higher t-stat and then the correlation was the same, would you still pick it because it has a higher t-stat?
No, this is the point of the exercise. Okay. Under statistics, okay, you would, since this one has a lower t and a lower correlation coefficient, you would pick this one and throw this one out and keep this one, okay, based on statistics.
Yeah.
But this one has been cited the most in the literature. In the
it's gonna be a fun test.
peer review articles. So this one was cited the most in the peer review journal articles, maybe also in the industry. In the industry research, which basically makes up the literature and the theory. This one just happens to have a higher t statistic and a higher correlation because of the data sample that you're using. But this variable has been cited the most in the literature, in more peer-reviewed journal articles, in more industry research papers over time. So this just happens to have a higher t and a higher correlation. This one has been proven consistently over time in the literature as being the variable that you want in the model. So you throw this one out and keep this one. Even though this one has a lower t statistic and a lower correlation, you keep this one because it's based on theory.
And that's the only reason why you keep one with lower t and lower core.
Yeah, because it's cited the most.
Okay.
Okay, it's basically part of the theory, part of the literature. Okay, it's been proven consistently over time, and it's still highly correlated, but not as highly correlated as this one. Okay, so this is your external validity. So that's external validity. And then, if the model, you come up with the model, right? You come up with the model with the variables in it, right? And you come up with the model with the variables in it, and you take the model and you take the variables and you have it vetted by senior level executives within the firm who've been in the business for a long time, and they basically vet it and they okay it. Then you got buy-off, and you also have internal validation. So you need both. You need internal and external validation, because nobody's gonna believe your model. If Roy at the bottom of at the end of the table there said, well, he was developing the model over the last 2 months, I was never asked about it. He didn't ask my advice, and I've been in the business for 30 years, why didn't he ask me? What was he trying to hide? No, I go straight to Roy and I say, Roy, what do you think? What variables do you think it should be in the model? Does this look like a really good model? Would you use this model? Yeah, I think it looks pretty good. You might want to try something else. How about you? How about you? How about you? How about you? And then you get internal buy-off, internal validity, based on their experience. And then you get external validity. Now you got a model, you got the variables, you back test it, you forward test the model, it works. You basically do the projections, make the recommendation. If you're right, you win. Okay, and you go do it again. Right? That's how people do it. And you do it over and over again. That's what happens to me. I got a call like 4 years ago. You built that model, can you build it again? Yes. Will you do it for us? Yes. What's it gonna cost? I want half the profits, okay, if it's successful. Okay. Have you done it before? Yes. Show me. Here's the doctoral dissertation. Here's the articles that I wrote. Here's all the publications that were written 9 years ago when I did it back then. Okay. Any other questions? Does that help? Okay, cool. And the problems are easy, right?
Yeah.
Except for maybe that bond one where you have to do the interpolation. You know, where you gotta take the coupon multiplied by 1 minus, 1 divided by, the discount factor divided by the discount factor to get the multiple multiplied by the coupon.
Which one's that one?
Oh, and one price?
Yeah, it's the, no, not the bond price, where you have to calculate the yield to maturity.
Oh, it's 8.10.
Where you use this one,
Mm-hmm.
you're actually using this. You're using this equation, right, for this question, right here. Because they basically say, okay, right, the price is here, right, what's the yield to maturity? And we know that the market price is gonna be, market return, the yield to maturity is gonna be higher than the coupon,
Yeah.
right? Because it's trading at a discount. The question is it 7, 8, 9, 10, 11, 20, what is it?
Yeah.
And what they wanted you to do is basically take these inputs, plug it into this model right here, and then take up the discount factor to the point where the price of the bond matches that price, so that the discount rate is your yield to maturity. So everything else stays the same, right? That's 30 bucks, and this is what, it's a 4-year, what is it, a 4-year bond,
Yeah.
and it's 2, so it's 8, right? So that exponential right there is 8. And we're using, what's the coupon, 6, so we're using 0.03 there. And then 30 there, that stays the same. So that's 1.03 to the 8, right? So what you would do theoretically is you would take this equation and do it by, what is it? This is gonna be 0.05, right? Because it's semi-annual, right?
Yeah.
So what you would do is you would do it as 0.0, maybe put in 0.04, use that one, run it, and then do
So
a
it's
0.05.
just gonna be a trial and error.
Yeah, it's trial and
I
error.
Okay.
always forget
But I
that's
just,
there.
I already
Yeah.
gave you the answer, so,
Yeah.
you know,
Yeah.
the question is, would you know how to do the interpolation?
No, of course.
Do you understand that you would have to get to to get to a discount, you have to take up the market interest rate to get it to the price, to get the yield to maturity.
Okay.
What happened?
I stood in front of it.
That's fine.
No,
As long as it's still recording.
my sweater.
Don't worry, that doesn't offend me.
Those students are gonna be watching it like,
That's okay. Nothing like a little grunge lecture, right? Alright, so do you understand how you would take up the discount rate to get to the price? Once you get to the price, then that's gonna be the yield to maturity. So you're interpolating, right? The higher the discount rate, the lower the bond price.
yeah.
Right, so we knew it wasn't 6%, so you try 8%, and you try 10%. Oh, at 10%, semi-annually, we got the price of the bond. That's the yield to maturity. And
So
then
it's
you
just,
got-
it's just plugging the numbers and figuring out the percentage.
yeah, and so usually you can do it with a calculator, but they want to teach you that you understand that there's an inverse relationship between the discount rate that you're using and the bond price. So if you need to calculate the yield to maturity and you know the bond price, you gotta keep taking up the discount rate until you get to the price. And at that discount rate, that becomes the yield to maturity. The problem is that you're using semi-annual compounding. So you have to multiply, it's 0.05. So you gotta multiply it by 2 to get the 10% yield to maturity.
And that's online?
No, it's right there.
No, I mean like that packet is like displayed online?
What do you mean? I already gave you that.
Yeah.
Oh, yeah, that's online.
Okay.
But I talked about, what I was doing when I was explaining the solution was I was using this, how to do the interpolation. Instead of using this one, you'd be sitting there for hours calculating this. This is the shorthand version. You could, if you memorize that, you can do that stuff in your head. You just burn it in your brain forever. Took me forever to memorize that. Okay, any other questions? And again, you know, if you get stuck on anything, you know, I'll do it again on Wednesday.
Or there's another one of these on Wednesday.
Yeah, I'll do it again, and I'll send you the, I'll send out the,
Wait, are we doing it all?
review. Huh?
Sorry.
That's all right.
So when we're doing this, since this is semi-annual and the one that we have here is annual, so
Yeah, you'd have to double,
60,
you have to divide the interest rate. Yeah, that comes out to be 3%, right there, so it comes out to be 30.
yeah,
So that's what you're using.
I would be using this
Yeah, over here.
for C.
So, where is it? Yeah, but I'm looking for the other one. Where's the other bond?
Bond.
This one right here. So you're using 30 right there.
Yeah, this is that one.
Yeah.
I
Right, but I'm
would-
just saying, instead of using 80, that's annual, you're gonna have to
Yeah,
cut it in half, which is what you did.
yeah.
So the 6%,
Mhm.
right, times the 1,000 is gonna give you 60, divided by
Yeah.
2 is give you 30, so that's gonna be your coupon.
Thanks, Professor.
All right.
Okay.
Right, 8% times 1,000 is $80,
Mhm.
right? That's an annual bond, this is
Yeah.
a semi-annual bond.
Yeah.
So you gotta divide the 6% by 2, that
Mhm.
gives you 3%.
Yeah.
0.03 times 1,000 is $30, so that
Yeah.
goes right there.
Okay.
Okay, and then what's that, 4 years,
Yeah.
right? Semi-annual, 4
Mhm.
times 2,
Mhm.
8.
Yeah.
8 goes right there,
Okay.
goes right there, right?
Yeah.
And then we wanted to interpolate it,
Mhm.
right? So let's say I don't use 10, let's say I try 8 first, 8%,
Mhm.
so that's gonna be 0.04. 0.04,
Okay.
0.04. You get it? And then you would take, and then you would And then nothing else changes. So if you were gonna take it up to 10%, that would be 0.05, 0.05, 0.05, right? 8, 8, 8, 30,
Yeah.
0.05, 0.05, 0.05. So the only thing, once you set it up, the only thing that's gonna change is the discount rate, the yield. Right, if I ran it at 6%, if I did, 0.03,
Yeah.
right here at 30, I get $1,000,
Yeah.
right? If I take it up to 0.04, all right, it's gonna be, I don't know what the price is, but it's not gonna be 868.
Yeah.
But if I take this to plug in 0.05,
Thank you, Professor.
if I point in 0.05, I'm gonna get that value.
Okay. Okay. Yeah.
So what they're trying to teach you is that, do you understand semi-annual compounding? And then do you understand how to get to the price by taking up the discount rate? Once you get to the price, that's your yield to maturity.
Okay. Okay. Yeah.
That's the hardest problem on the exam.
Okay. Like this.
Yeah.
And then this would be 1,000 over the
That'd be plus 1,000 divided by 0.05 to the 8.
Okay.
And you might wanna go ahead and do the calculation and see if you come up with that,
Yeah.
just to test it. It's easier just to use the calculator to do it, but I need you to memorize that stuff,
Yeah.
the mathematics. I don't know if that's right. I don't think that last one's right. I think it needs to be discounted. I don't think it's divided by 0.05. It's divided by 1.05 to the 8.
1.05. Okay.
Yeah, it's a discount factor when you're trying to get the present value. Yep, that's it. Now try it.
Did you like it? No, did you really? Yeah, 686. Or no. Let's see.
What I would do is I would calculate these separate and then add them
Yeah.
together like they did before. Or calculate this piece first. Right?
Yeah, that's what I'm doing.
And you might have forgot to take the 1 minus this right here.
Yeah.
1 minus that divided by that. So it's a little tricky.
Yeah.
What I do is I do the pieces of the calculations first instead of trying to do it all in one.
Oh yeah, no, I'm not.
Okay.
Yeah, so I got 870.
Let's see, what was the answer?
868.43.
Yeah, it's just a rounding.
Yeah.
This is the
Yeah.
decimal point thing.
Okay.
So that's close enough.
Okay.
Well, let's see.
Okay. And so when we bring in the blue book, it shouldn't have anything written in it, right?
I'll bring some blue books too. If
Okay.
you want to bring an extra, that's fine.
Okay. Yeah, I just wasn't.
I would just check it.
Today.
I'll just check them.
Okay. But we can't write notes in there, though,
No.
right? Okay.
No, I wanted to see what you can remember.
Yeah. That makes sense.
Because you'll have a chance to go back.
Yeah.
I just want you to be able to test your brain.
So after we do the test, like after this week, you'll hand back the blue books with the corrections.